So we want to talk a little bit about our process. We will analyze the facts and determine the probable cause of the accident and then issue a report of those determinations. I also want to talk a little bit about some additional people that are here with us, and they're very important to us, and that is our family assistance group. Later today, we will be briefing the families. We normally try to do this before a media event, but in this case, they're still arriving. Our family assistance specialists are already working closely with local officials and others to help assist them in their efforts to support everyone that's affected by this accident. And let me just reiterate what the chair said. A loss of life in an aviation accident is very unusual in the United States, and our heartfelt sorrow goes out to everyone that's affected. It affects us, it affects everyone around us. There are a lot of people hurting today. We will help find out what happened. We will do it factually, and we will do it accurately. As part of this, we are going to be standing up some specific working groups. Those working groups will be operations. They will be looking at the history of the accident flight and crew members' duties for as many days before the crash as appears relevant. We'll be forming a structures group, which will be the documentation of the airframe wreckage and the accident scene, including calculation of impact angles to help determine the plane's pre-impact course and altitude. We'll have a power plants group. They will do the examination of the engines and the engine accessories. We'll have a systems group. They will study the components of the plane's hydraulic, electrical, pneumatic, and associated systems, together with the instruments and elements of the flight control system. We'll have an air traffic control group. They will do reconstruction and review of air traffic control systems provided to and including acquisition of pertinent flight track surveillance information, what you might typically think of as radar or ADSB, along with controller pilot communications. We will also have a survival factors group. They will be doing the documentation of impact, forces and injuries, community emergency planning, and all crash and fire rescue efforts. Also, due to the unique nature of this crash, we will be having a helicopter group as well. Lastly, we will have a human performance group, and this will not be its own group. It will actually be a part of the operations, air traffic control, and helicopter groups. They will study the crew performance and all before the accident factors that might be involved in human error, including fatigue, medication, medical histories, training, workload, equipment design, and work environment. Now we're going to take a few questions, but I will again stress, we don't have a lot of information now. We will continue to gather that.
That was the NTSB giving the latest update on the deadly air collision at Reagan National Airport. NTSB saying they have nearly 50 people on the scene, and they're going to find out what happened factually and accurately. They will leave no stone unturned, and it is their goal to have a report within 30 days. They also speculate they will not be speculating about the cause of that accident. Romain?
All right, you are watching the close, of course, as we count you down to the closing bells in financial markets. And of course, we will be keeping an eye on what's going on with Washington. But there is a lot of news out there on this day for investors to keep an eye on. And of course, that includes what has been a deluge of earnings over the past 48 hours or so. And that will continue later tonight with more earnings out of companies like Apple, out of earnings like Intel. And of course, that comes on the heels of earnings that we got out last night out of IBM, out of Microsoft, out of Meta, out of Tesla. Adding this all up here, some big questions for investors about market valuations, and more importantly, some big questions here about whether you hold positions, trim them, or buy. Denny Fish joins us right now, portfolio manager over at Janus Henderson. And Denny, I do want to start off first with the earnings that we are going to get tonight. We got a little bit of a taste of what big tech has in store. I'm not sure how much we learned last night, given the divergence in some of those earnings. But when you take a look at Apple, obviously one of the most important companies out there, if not the largest, what exactly is the expectation for you and the rest of this market?
Yeah, well, for Apple, I actually think the expectations are fairly muted. I mean, if you just look at consensus, it's just looking for 3 or 4% revenue growth, I believe. And, and I think the expectations have come down, over the last, 2 or 3 months, just as, The unit data has looked like it has been relatively lackluster. So I think it's just kind of lukewarm. I mean, for Apple, I think the broader thing too is, with Apple Intelligence and thinking about that, we're still very early. It's not really something that's, widely available globally. It's been coming out in bits and pieces, and therefore it really hasn't been enough to drive, a real upgrade cycle. And I think for investors, it's really being patient and looking forward to the 17, which will be out later this year, and how Apple Intelligence evolves, to see where the stock goes from here. But I think, if you even just look back last week, the stock was under pressure, and it actually got a little bit of a tailwind here early in the week with some other news that we had that we could talk about as well. But
I assume you're talking about the elephant in the room that is DeepSeek and whatever sort of havoc that wreaked on this market. And of course, we saw some of these questions come up on the conference calls yesterday with Meta and Microsoft and a few others. Obviously, the executives there seem to be kind of shrugging off the potential impact, and that CapEx spend, and more importantly, that AI fever dream still seems to be intact, Denny.
Yeah, it does. I think what's important is, I've followed artificial intelligence for the last decade. And, it's really since ChatGPT 3 came out that the world's recognized what the power is. But if you just watch what's happened over the last, couple of years, there's this constant leapfrogging that's occurring. And we're just on an incredible pace of innovation curve. And that's what happened with DeepSeek. They did some novel things that were really unique, that will, quickly get incorporated by the Western models as well. And we'll just keep pushing on this thread. I think, some of the broader questions now are, what is going to be the mix of compute between training and inference, and what that might look like going forward. But to your point, last night we heard from Mark Zuckerberg, we heard from Satya Nadella, and, both, suggested that CapEx is going to continue to go up. And interestingly, even Microsoft, when they talked about their CapEx, they were talking about, it's actually going to be more on equipment and chips as a percentage of the mix relative to the data center footprints that they've been putting in the ground. And, Zuckerberg had the pedal to the metal in terms of talking about what they're going to be doing.
Right. So, Danny, I'm interested in that. Why do you think that Microsoft got so punished versus, say, Meta?
Yeah, it's just the Azure slight miss. And it's just fascinating, when everyone's hanging on this. And the other thing is, Microsoft has suggested that things would start to accelerate in the back half of their fiscal year, which is the March and June quarters. And that seemed to come off the table. And, while you still have CapEx going up and you miss expectations a little bit, then it calls into the question with some investors about this mismatch in the timing of revenues, ROI, relative to the CapEx that they've already spent.
It also brings up the expectation game, Denny, which leads us to Apple after the bell. They've already sort of moved expectations a lot lower. What's the bar to beat?
I don't know. It's always hard to say. Like I said, consensus is somewhere around 3 or 4% revenue growth. I think just, given the stocks underperformed this year, just something in that neighborhood, because investors that are really bullish on Apple, they really don't care about this quarter. It's looking to the potential for a sustained upgrade cycle with the 17, as I mentioned earlier.
Denny, I was taking a look at your main global technology and innovation fund. Obviously, some familiar names at the top of that list, like NVIDIA, Apple's in the mix as well. Just kind of put on your, look into your crystal ball a little bit. When you look at sort of how this AI trade plays out, and more importantly, the development of the end use case for AI, what is that list of top tier companies in this fund going to look like in 5 years from now? I assume it's going to be more than just NVIDIA, Microsoft, Apple, and Taiwan Semi.
Oh, yeah, absolutely. But, we've been in that enablement phase, right? And so that's actually been the right answer. I mean, we fully expect this to broaden out, with the fullness of time. And it's going to have, really positive, impacts across the software ecosystem, the consumer internet ecosystem, e-com, fintech. And so, the important thing that we do is, it's not going to be a rising tide lifts all boats. You figure out who's really going to be a beneficiary, where AI can move the needle. where it's improving the value proposition. Those are the type of companies that'll move up in the portfolio over time.
All right, Denny, always love talking to you. Denny Fish, portfolio manager at Janus Henderson, kicking us off to the close. A lot of discussions coming up here on the big program, including a look at energy infrastructure, a look at UPS, and of course that drumbeat to the big earnings after the bell. Stick with us. This is The Close on Bloomberg.
I think as we see more and more adoption of AI, there's going to be more and more demand for compute power. It will happen in data centers. The form of it may change a bit, but we still think it's essential, as is the energy and power, which we think will continue to be needed. So we're going to continue to operate in a very disciplined way. We're going to build when we have demand from our tenants.
That was Blackstone COO John Gray on AI adoption and that growing demand for data centers to power them. Speaking of, energy companies crucial to the AI build-out are struggling this week after that tech sell-off was sparked by DeepSeek. And among them is Terawulf. The company owns and operates data center infrastructure in the U.S. for Bitcoin mining and AI computing. And their CEO joins us now, Paul Prager, the co-founder, chairman, and CEO of Terawulf. Basic question. Are we overreacting to the DeepSeek issue and power demand?
100%.
Okay, why?
Power demand's not going away. For the data center, for our customer, Core 42, G42, it's business as usual. For the customers that we don't have yet under contract, but we've been in discussions with for a year, the demand for power is significant. And not all power is created equal. There's a difference between power needs out 6 years, 10 years, versus what Terawulf has, which is power now, and liquid-cooled power availability.
So where do you sit in the AI power demand world? Like you're a Bitcoin miner, you also have renewable and also natural gas power. Where do you sit in the stack?
We're top shelf. I mean, to be honest with you, Core 42 could have gone to 60 sites. They elected us because we had readily available power. So the key is, do you have readily available power? Do you have water resources? Because it's all about liquid cooling. Is it sustainable power? Our power is sourced from a combination of hydro facilities and nuclear facilities. So all of those combine to make it, the first choice for the customers that are looking to get data centers online quickly.
Well, that's what I'm curious about on the geographic basis, because we know that's a big factor in how efficient these operations can be. Where do you sort of, factor into that? Are you selecting the sites in advance of these contracts, or do you wait till you have the client and then you're making a decision about them?
So the genesis of Terawulf was we were a power developer, owner, and operator. In fact, your prior guest, we bought out Blackstone's interest in a power portfolio. And in fact, one of those assets today is our primary site, Lake Mariner. So we have the sites. We are, at the end of the day, an energy infrastructure company that is looking for the highest value for our megawatts. Right now, data centers are the highest value for the megawatts. So we have the sites available, and we build to suit depending upon the customer's needs.
So your expansion isn't really about an additional land grab. It's about utilizing, or monetizing what you already have.
Monetizing existing sites or developing other sites that could be suitable for the right HPC AI customer.
We have a variety of different contracts that have sort of been signed between power companies, energy companies, and big data centers, like Microsoft, for example, and 3 Mile Island. What kind of contracts are you guys signing?
So we looked at the hyperscaler space, and we elected to move to the co-location space.
Okay.
So we have a contract with C42, which is backed by G42. It's a wholly owned subsidiary, which is backed by Mubadala. They're part of the MBX, Stargate, enterprise that President Trump, has provided some information about. They have a variety of customers, both, the training model customer, the inference customer, enterprise customers. They aggregate them and they come to us for the energy need. And we also build the data center and operate the data center for them.
That's a lot. That sounds expensive.
It can be expensive, but at the end of the day, it's a lot less expensive from Terawulf's perspective for our customer than most other places, because again, we have 2, 3, 45 kV lines. I know that's technical, but at our site was the site of a huge utility-built power facility. So we have every bell and whistle at that site. 2, 3, 45 kV lines in to bring the electricity. Hence, you don't have to have backup diesel generation. That saves a couple of $1 million per megawatt in the build-out cost for the customer. We have transformers already. That saves time and build. We have redundant transformers. So at the end of the day, we could build something at $6 million a megawatt where somebody else is going to be $8 or $9 million a megawatt. And that is to the benefit of the customer.
I have to ask you about the regulatory environment. I mean, what's the bigger hurdle for you right now? Federal regulations or the state and local regulations?
To be honest with you, we don't have an issue. This was a mitigated coal-fired power plant. She's located in a great spot. We have a great relationship with the grid operator. In fact, New York has been very kind to us because we mitigated these coal-fired power plants, and now we're bringing high-tech jobs to that area in northern New York. So, in western New York. So it's a pretty exciting opportunity. We don't face regulatory issues at all. And when we were just in the Bitcoin mining phase, we welcomed the regulatory environment because we thought it leveled the playing field.
All right, Paul, great stuff. Paul Prager, co-founder, chairman, and CEO over at Terawulf. Of course, that big drop on Monday, recouping some of those losses over the last 3 days, including an 8% bump here on this Thursday afternoon. Meanwhile, to the opposite end of the spectrum, the biggest drag on the S&P is Microsoft, an overcast day for the software giant after reporting slower growth in its cloud computing business. A deeper dive in our top calls coming up next, right here on The Close on Bloomberg. All right, let's get a view from the sell side. This is where we do our top calls, big movers on the back of analyst recommendations. And we're going to start off today with the furniture company RH. Goldman's Kate McShane, who cut the stock to sell 2 years ago, today upgrading her recommendation to neutral, saying new products and a heavy focus on marketing is working. This despite what she calls a depressed housing market. RH also reducing exposure to tariff-prone countries like China and Mexico. She says the share is getting a nice pop, up about 3.5%. Next, Coca-Cola. Jefferies upgrading to buy, citing what it calls increasingly unmatched fundamentals. Jefferies says the soft drink company is in great shape as volumes compound globally and free cash flow nears closer to inflection. And finally, let's take a look at Lamb Research. Raised to overweight from neutral at Cantor Fitzgerald. The price target getting a slight bump to 100 from 95. The analyst highlighting, an uptick in the chip maker's NAND flash memory technology and says the company's attractive valuation and EPS potential make it too good an asset to wait. Those shares up 9%, their best day since at least mid-2023. Those are some of our top calls, and now we're going to flip and turn to what's been going on the software side of the equation, at least when it comes to Microsoft. Its fiscal second quarter report featured weaker than expected revenue in its cloud business. While AI services did grow 157%, there's still concern about the limited data center capacity, and you see that reflected in the share's biggest drag on the S&P 500 today. Kash Rangan joins us right now, who covers the software sector in global investment research for Goldman Sachs. He rates Microsoft a buy. Kash, are you rattled at all by this earnings report last night?
No, you go through covering a stock like Microsoft for a number of years. You learn to distinguish the noise from the real substance. And I think this is one of these quarters where the longer-term conviction is enough in the quarter to beef up your longer-term conviction in the stock. RPO, standing for Revenue Performance Obligation, a good measure of booking strength. $300 billion, up 75%. But you don't see things like that. So I understand why the stock is down, but I do feel convicted that the long-term outlook of Microsoft, which should ultimately drive the share price, remains, if anything, brighter after this quarter.
What actually do you think, though, that management should do next with regards, not just in terms of building out the business, but also kind of communicating to the street what that long-term vision is so you don't get these market reactions? So if you believe there is a long-term upside here, when are we going to see that communicated more effectively?
I think you have to take the steps before you can run, right? So the long-term conviction investors' mind is built up based on short-term steps. If you can execute to those steps, the share price should take care of itself. So I think what needs to happen is Azure needs to put up another solid quarter, maybe at the high end of the range. 31 to 32 points of growth is actually very, very good, solid growth at scale, right? I think the expectation was that in this quarter, the December quarter, that they would do better than 31, maybe coming at 32. They did 31. Not a whole lot of difference. Right? We understand that these can be somewhat disappointing, grossly disappointing in the very short term. In the long run, between 31 and 32, not a big deal. But having said that, for the stock to work, you need to see that Azure in the upcoming March quarter steady at the 31, 32, hopefully 32% range. And then more importantly, point to how the capacity alleviations that are coming on stream with more data centers being turned on in the March and June quarters lays the groundwork for more sustainable growth, maybe even a bit of acceleration as you exit this fiscal year going into June. If they say all these things, the stock should work because you got earnings power and you've got a big balance sheet and you've got forward-looking tone of business looking very, very solid.
So what's my read through then to the likes of like Amazon Web Services or Google's cloud business or Oracle's cloud business if 31% growth just wasn't enough to cut it for this quarter for Microsoft?
Yeah, you can look at it from the perspective of AI. So this quarter for Microsoft in Azure was a better read across for AI than the cloud. So if you are a skeptic, you'd say, take away 13 points of contribution from AI. The core is 18 and the core has been kind of 22 to 25%. It kind of decelerated. So one would be tempted to make the conclusion that either they lost share or the industry slowed down, which I think are not exactly the way I would interpret these results. This seems to have been a bit of a distraction or resource allocation or maybe contention. These are things that can be worked on, right? So with the right level of sales incentives, you could get the cloud business to reaccelerate back again. But I think as far as read across for the AI world is concerned, it continues to be, we're still in an infrastructure build out mode. We've been saying as a firm at Goldman Sachs that the stage of AI is infrastructure, which is where we are right now, moving to platform, and finally applications, things that make money and productivity, offer productivity benefits for end users. That's the final stage of the cycle. So we're still in the infrastructure build out. It looks like from the CapEx growth rate that Microsoft's guiding to, that infrastructure build-out cycle has peaked at plus 75% or so, judged on Microsoft's CapEx fiscal 24, to comfortably in the 40-50% range for this year, going to something slower than that the year after that. So that does not mean AI is slowing. It's just that we built this infrastructure, made it possible to build. We will be making it possible to build applications. That's next.
Kash, we got to leave it there. Thanks a lot. Kash Rangan over at Goldman Sachs. Microsoft off by about 6%. Coming up, the CEO of UPS. This is Bloomberg.
We welcome our Bloomberg TV and radio audiences. 3:30 p.m. here in New York City. This is the countdown to the close. I'm Romaine Bostick.
And I'm Alex Steele. Let's turn back to earnings. We are watching shares of UPS right now falling the most on record to the lowest level since 2020. This comes after revenue for this year missed estimates as the company winds down its relationship with Amazon, which makes up almost 12% of its revenue. For more on this, we want to turn to Carol Tomé, CEO of UPS. Carol, thank you so much for joining. There's a lot of little threads to pull here for UPS, but clearly investors are skittish, and it was really that Amazon news and your revenue forecast that did it. When did you make the decision to part ways with Amazon?
Well, it's wonderful to be with you both. And let me just describe the relationship that we have with Amazon. It goes back nearly 30 years, and we have great respect for the company. They are our largest customer, but they're not our most profitable customer. And our contract was coming up for renewal this year, and it gave us an opportunity to step back and assess how we wanted to drive the relationship going forward. We considered a number of different options and alternatives and landed on this, which is an accelerated glide down of their revenue, taking it down more than 50% by June of 2026. Now, it was a lot to digest from a market perspective, but here's the real bottom line. If you look at the guidance that we gave for 2025 for our U.S. business alone, with the Amazon glide down, our average daily value will drop around 8.5%. Our revenue will only drop about 2%, but our profit in the United States will grow by nearly 15%. We'll grow profit dollars by making this change. So we are taking control of our destiny and allowing ourselves to grow into the markets that really value our end-to-end network.
Right. So you're sacrificing volume, but for the right kind of customer. So that in many ways makes sense. Did this come from you guys, or did you call Jeff Bezos, or did he call you? Did they start the contract negotiation, then you were like, no thanks?
No, this was absolutely our decision. We ran with this.
I am curious, Carol, with regards to this decision, FedEx went through something similar a couple of years ago, and I know your businesses aren't exactly apples to apples. They had some issues in trying to sort of work through, I think, the vision you're laying out for effectively a more healthy stream of revenue. What is the time frame that you're putting on this before you start to see a return and erase effectively any potential losses in the short term from this?
So we'll have a glide down through June of 2026. But the operating profit and operating margin will continue to improve. And by the end of 2026, the operating margin in the United States will reach 12%. In terms of growth, we're leaning into the areas of the market that value our end-to-end network and our differentiating capabilities, areas like SMBs. Our SMB volume grew in 2024. It will grow again in 2025. Areas like healthcare logistics. Our healthcare logistics business grew 5% last year against a market that only grew 2.5%.
Right.
And next year will grow nearly 8%. So we'll be gaining the revenue back, but quality revenue. And the addressable market's big, so there's lots of opportunities for us to grow.
Carol, based on the market reaction today, why is it that this is the first time we're hearing about this publicly? Was there not a decision made maybe to communicate this, or communicate meaning the severing of the relationship with Amazon, or the wind down, I should say? Was there any discussion about maybe communicating this in a pre-announcement prior to the earnings day?
It's a very fair question. And in fact, we debated this with our advisors if we should have a separate investor call on this particular decision. And collectively, we agreed to put it all into today's earnings release. I know it's a lot to digest, but as the days and weeks play out, I think investors and analysts will digest the information and understand that for the long term, this is for the health of UPS, and UPS is driving its strategy.
Talk to us in the meantime, though, about small package growth. It is a tough market, and that's irrespective of Amazon and irrespective of the United States Postal Service. It's just a tough market. When do you think we're going to go back to some real overall growth, and can you steal some market share?
Yeah, you know, this is going to be a share story for a while, I think. The small package market in the United States is expected to grow in the low single digits. So how do you win in a marketplace like that? You've got to take share. And how do you take share? You do it by investing in enabling capabilities. For us, that includes capabilities like RFID tagging, which initially drove productivity in our business, but now provide upstream inventory visibility for our customers. We've seen some significant customer wins just because of that capability. Capability like store replenishment, where now we can give retailers time-definite delivery, which allows them to make sure their in-stocks are in good shape and lowers their cost of labor. Differentiation capabilities like cold chain logistics. The complex healthcare logistics market is over $80 billion opportunity. We just announced another acquisition of this capability in Germany, a company called Freakley. So we see an opportunity to reach $20 billion in healthcare logistics over the next several years.
Carol, though, if you're going to compete and steal market share, does that mean you're going to have to compete on price, which then winds up hurting that margin story and the profitability story that you're trying to sell?
Yeah, so we are differentiating on capabilities, and customers are willing to pay for complex logistics. So we're not chasing all packages. We're leaning into the complex logistics parts of the market where the revenue quality is quite good, and we're very focused on revenue quality.
I am curious on that complex logistics part, and particularly the technology and machinery that goes into that. Are you increasing your capital expenditures in that space, or is the money for that, has that already been telegraphed to the market?
Well, it's a terrific question. Our capital spending has come down considerably. We'll spend around $3.6 billion of capital in 2025, in line with our depreciation. That's down from what we had been spending, but it's principally because of the reduction in the volume associated with Amazon. So we don't need to purchase as many vehicles or aircraft, and we can then optimize the capital against more technology. So if you unpacked how we're spending our dollars, you see more capital being shifted to technology and these enabling characteristics.
This is a broader question, and it really is about the technology spend that we're seeing across a wide variety of industries, whether it's in AI or things similar to AI. What has been the discussion that you've been having with your deputies and maybe to a certain extent with any external accountants about the best way or the most efficient way to spend and invest in this space rather than, some companies basically just throwing everything at the wall and seeing what sticks?
Yeah, we are a big believer in pay by the drink. We like to develop and launch a small initiative to see if we get a return, let that return then pay for the next initiative, so on and so forth. From a technology perspective, particularly generative AI, we've been focused on productivity investments, which are really easy to pay by the drink. Mm-hmm. As we think about expanding that now to customer, we'll do the same sort of thing. We'll test and learn, and spend in increments.
Carol, last question. President Trump is signing some executive orders and some memos in the Oval Office. And again, he reiterates to reporters he's looking at a 25% tariff on Canada and Mexico. Are you noticing any changes in shipment, demand, rerouting, anything on tariff threats?
So, Alex, to date, we have not seen any change. And let me just put it into perspective for you. Last year, on average, we delivered 22.4 million packages per day. Of that amount, less than 400,000 packages per day were imported into the United States. So our exposure directly is less than 2% of our volume. The other thing I will say about tariffs is that we are well positioned to address the customer's needs if tariffs do go into place, because shippers may do nothing. They may put the cost of the tariff into their price, or they may think about a change in mode, perhaps moving from premium air to ocean, or they may change destination and origin. And with our global integrated network, we can serve our customers any way they need us to serve them.
Carol, we always appreciate you taking time for us on an earnings day. Carol, of course, CEO of UPS. And just a quick note to Alex's point about those comments from Trump on tariffs, a big downdraft right now in shares of Ford and GM. And I think based on what we're learning now about potential tariffs, what Carol, of course, was talking about when it comes to AI and spending, CEOs across the globe are dealing with a tremendous amount of disruption right now. AlixPartners has an annual disruption index for 2025. It's out. And this shows that executives are increasingly looking to places like AI and digital technology to grow their businesses. Pleased to say that Simon Freakley joins us right now. He is the executive chairman of AlixPartners, of course, a global consulting firm. All right, you were just at Davos, so you really had, between what was going on with CEOs, what was going on with the governments and the government officials. I mean, what is kind of the biggest talk of the town? Was it AI? Was it tariffs and Trump? Was it something else? What?
Right. Well, of course, every year Davos has a theme. This year it was collaboration in the intelligent age. But actually, it was all about the new Trump presidency. It was all about growth. U.S. participants in Davos were almost giddy at the thought of the growth possibilities of a Trump administration, lower taxes, lower regulation, defensive strategies for U.S. businesses. And so the mood for U.S. participants was high and energetic. The mood for Europeans, not so much.
Yeah.
I mean, they have no growth over the last 5 years, half the growth of the U.S. I heard the most extraordinary comment by a very, very senior German industrialist who said, look, if this tariff war is going to happen, maybe as a country we're better aligning with China. I mean, can you imagine over the last 30 years that even being a consideration? So alive and well.
Alive and well. I want to talk a little bit about AI, and you mentioned China. So let's go with DeepSeek. I mean, that's really rattled the markets earlier this week. There's been a huge amount of spend by corporate executives, primarily here in the U.S., chasing after AI and all of the sort of ancillary things here. Was there talk then, prior to even knowing what we know about DeepSeek, that maybe some of that spend was either too much or maybe not efficient enough?
I think the sheer size of the prospective spend was awe-inspiring for people. And of course, whether 500 billion was going to be enough, who knew? I think the extraordinary thing about DeepSeek is, as we all know, there's three elements to the AI equations: the algorithms, there's the processing power, and there's the data.
Yeah.
The Chinese could get the data because it's all open source. They couldn't get the same access to processing power because they couldn't get access to NVIDIA chips and therefore didn't have the processing capacity. So what did they do? They took control of the one thing that they could control, which was the algorithms. And in a very intelligent and radical way rethought the algorithms so that they didn't need the level of processing power on which the current model is based. So it's extraordinary, it's revolutionary, and it's changed the equation. So whether that 500 billion will need to be spent, we'll see, but it's absolutely changed the game.
Right, it's sort of what that number winds up being is the tricky part. Simon, you mentioned the euphoria. I heard something very similar at a hedge fund conference the other day when I was there. Is the euphoria being put into practice? Like, how are CEOs executing this euphoria?
Well, of course, Alex, the problem is that this blizzard of executive orders happened during the middle of Davos. Nobody could read them quickly to really understand where they were going, but there was a general sense that it was all good for business, and particularly good for US business. So what are people doing? They're looking at how they can use AI and robotics and automation to drive productivity. Last year at Davos, the AI narrative was all about how to increase efficiency. This year, it was all about how to drive growth. And as we know, every investor worships at the altar of growth. Every CEO serves at the altar of growth. Revenue growth is a leading indicator of investor return. And so it was all about how to use these tools to drive productivity and growth.
What's the conversation, though, around tariffs? Romain was just mentioning the market moves that were instantaneous from comments from President Trump about 25% tariffs on Canada and Mexico. We're seeing oil move. We're seeing the peso move. We're seeing the loonie move. Like, what are they talking about in terms of the tariff risk?
Yeah, so this is the thing, Alex. At the beginning of the week, on the Monday, people were really quite concerned about this, disturbed by it. By the end of the week, they'd almost put it to one side and said, we're going to figure it out. We will figure it out. There's enough levers now for growth for us to be able to work out how to deal with tariffs. Yes, we're going to have to rethink our supply chains. Yes, we're going to have to rethink our economic models. But you know what? There's more upside than downside in this.
So we talk about the upside, and I know CEOs by their very nature are supposed to be optimistic. They're supposed to communicate towards the future. In the time that you've been, not just in the role as executive chairman, but in all your career, have you seen this type of uncertainty on the horizon at this magnitude? When was the last time you saw that?
Well, this uncertainty, of course, has been around for a while. The disruption index that you mentioned that we produce every year, this year we've just produced our results. What it shows that on average, people think that the world is just as disrupted as it's been for the last 4 or 5 years. But when you look within that data, the Americans feel more optimistic, the Europeans feel more pessimistic, and the Asians are much more aligned, the Asian markets much more aligned to America. So on average it's the same, but when you look beneath the surface, there's a lot of anxiety on the global stage, a lot of optimism on the US stage. And so I think that as people look into the opportunity, they see more opportunity than risk in AI. There's clearly risk. I mean, two biggest risks for CEOs at the moment, per our study of 3,200 CEOs, is cybersecurity and data privacy, which is the flip side of the AI coin. But on balance, they see more opportunity. And importantly, Romain, what our data shows is that CEOs are just getting better at dealing with these multiple uncertainties. They're getting better at pivoting. They're getting better at taking advantage of the pivots.
Well, I'm glad you bring that up, too, because I remember a couple of years ago, we did a bunch of segments here on the types of CEOs that were being hired. And for that matter, even some of the other folks in the C-suite, and the idea that these jobs have become much more complex. It's not just about either being a bean counter if you're a CFO, or even just being, a transformative leader if you're a CEO. You got to be a politician. You have to do a lot of things here. And I am curious as to how much that job has changed over the years, and whether we could see a shakeout, meaning that there are just some CEOs that were kind of cut from the old cloth that maybe aren't necessarily ready for this new world.
I think you're absolutely right. If you look at the average tenure of a CEO in the S&P 500, it's almost halved over the last 12 years. Why is that? There's burnout. The skills that they need to have are different than they were 10 years ago. They have to be able to pivot quickly. They have to be able to surround themselves with the right talent for the challenges they face tomorrow, not the challenges they've had yesterday. Building the right teams. They have to know how their company is going to be digitally relevant in a fast-changing marketplace. They have to be able to manage multiple stakeholders. So it's a very, very different job than it was even 5 years ago.
Yeah, exactly. Simon, thank you very much. Simon Freakley, Executive Chairman of AlixPartners. And speaking of Romaine, just the headlines that have crossed, President Trump reiterating that first Canada and Mexico tariffs are coming Saturday, talking about 25%. We're seeing markets actually move, but we kind of knew all this was coming, but it adds to the volatility and uncertainty. Balance of Power co-host Kailey Leinz joins us now. Kailey, this was in the Oval Office. There's no cam in there, right? What was new about this that has markets moving?
Well, I think what's really new is that this is confirmation from the president that he does intend to go ahead with the implementation of these 25% tariffs on the U.S.'s closest neighbors and biggest trading partners on Saturday, February 1st. Now, to your point, Alex, he had suggested already that February 1st was kind of a deadline, is his mind. He suggested that on his very first day in office after his inauguration last week. And it was reiterated by the White House press secretary, Caroline Leavitt, in her first news briefing earlier this week as well, that February 1st was still the date they were looking at. Something interesting, though, from these remarks per our reporters in the room is that he said he will be making a determination on oil. Obviously, oil specifically a big end product, a big import from Canada. It would have the potential to impact crude prices, as we're already seeing today with a little bit of lift in crude futures. But that's something he's going to be keeping an eye on. But what the president is suggesting here in the Oval Office is that he doesn't see the U.S. as having need of the products coming from these countries like Canada and Mexico. He thinks the trade relationship is unfair, and a lot of this, too, in his mind, is about fentanyl coming over our borders.
Okay, whatever. Let's. But on the point, though, about the things coming in and out here, too. I mean, this is a huge cross-asset move, and we need our viewers to understand what's happening here. It's not just the peso, it's not just gold. Lumber going down as well because of a comment saying that apparently we don't need the lumber coming out of Canada. It gets to a question here, Kailey, as to whether the White House has either tried to articulate any sort of sense of how we, I guess, replace, if at all, any of those things. I know his comments are basically, we have the lumber, we have the oil, and everything else we need. I'm sure a lot of executives would disagree with that. When do we articulate more of where that supply is?
Well, it's an excellent question, Romaine. The president's intention, he says, by tariffs is to protect American industry, that he wants more of this coming from the U.S., inclusive, of course, of energy production, and that pertains to oil, as we were just discussing. But yes, you're exactly right. There's not a clear one-for-one replacement in a lot of these goods we are importing from both Canada and from Mexico, which is why many have pointed to the potential inflationary impacts of this shortages that could be created. But those in the Trump administration or those about to join it, including Howard Lutnick, who has been tapped to be the Secretary of Commerce, was testifying in his confirmation hearing yesterday, putting down as nonsense the notion that tariffs were going to cause inflation. Lutnick is supposed to have a big role in shaping the trade policy of this administration, though he is not confirmed yet. Scott Bessent, the Treasury Secretary, is. It's unclear what Bessent's view on this particular move might be or whether or not he's going to be supporting the president on this one. But this does throw a little bit of cold water on this notion that the threat of tariffs was simply for a negotiation, that it was a tactic for Donald Trump to extract concessions he wanted from these governments. It doesn't seem, at least at this time, that that's necessarily the case. It does look like he is intent on imposing these on Saturday, though I'm sure we're going to be getting responses from Ottawa and Mexico City in pretty short order, as Canada, for example, has threatened retaliatory tariffs on the U.S., suggestions even that it could be dollar for dollar.
Kailey Leinz over there in Washington, a flurry of headlines coming outside of the White House and the market reacting to them in full right now. The dollar getting a bid, gold back to a record high, a little bit of a movement in the oil space, a big drop in lumber, Alex Steele. And of course, we're also seeing some individual stocks also move lower that could be affected by tariffs. Of course, automakers, which have a big presence in Mexico, that cross-border transaction, Ford and GM near session lows.
Interesting, they singled out lumber and oil. Canada, we take a lot of their heavy oil. We don't have that here in the U.S. A lot of the refiners in the U.S. use that oil. You cannot replace it with oil here. You can replace it with oil from Venezuela, but that comes with a different issue as well. All
right, and this gets back to the questions I think we were asking, Simon, about this idea that there still is a lot of uncertainty. The president, at a moment's notice, can move markets, and he has done just that. As we take a look here at the broader market, the S&P holding on to some of those gains on the day, up about 0.4%, Alex.
Yep. Speaking of, we've had an immediate drop down on those headlines. We're off the lows of the session, but still well off those highs. Tech now flat on the day. Microsoft still very much underperforming. Even the Russell that's outperforming most of the day, the gains are now just up by about 0.9%. Tough tape as we head into big earnings.
Big earnings coming up after the bell, including names like Intel, Visa, Weyerhaeuser, Deckers, Atlassian, and a company called Apple. Doug Clinton joins us right now, founder and CEO of Intelligent Alpha, counting us down to the closing bells with just about 8 minutes to go. And I want to get to Apple in just 1 second, Doug, but I just have to ask you just about how much attention investors have to pay to Washington right now, whether it's about tariffs or AI regulation or anything else. We now have a president back in office who we know can move the markets with just one simple word.
Romaine, as it pertains to tech, I think you need to pay more attention to regulation than you probably do to tariffs. If you think about, the last 4 years with tech, a lot of the story has been about investigations into big tech, sort of the monopoly power that many of these companies have, and then ultimately the inability for them to do much M&A. So on the tech front, we're really focused on, does the M&A market open up a little bit more for these companies, and can they get creative in terms of how they try to expand their business beyond just building the next generation of AI models?
Well, let's talk a little bit about that. Of course, a lot of the discussion last night when we got those earnings out of Meta and Microsoft and even IBM for that matter was really about that AI spend. We're going to hear from two interesting companies after the bell. Intel, obviously a chip maker that's been a bit of a laggard. And Apple, of course, once the world's largest company, has surprisingly also been a bit of a laggard as well. What are you expecting out of those earnings tonight? Is this just going to be about smartphone shipments, or is this going to be more about AI or whatever it's calling, Apple Intelligence?
I always think it's a little bit about AI for any company now that is in the tech space when it comes to earnings. For Apple, the story a year ago was really, could Apple Intelligence, their AI platform, bring us into a new world where customers were upgrading their iPhones more frequently? And I think now that Apple Intelligence has been out in the wild a little bit, we really haven't seen that push. Apple Intelligence hasn't been, a strong enough catalyst to push iPhone upgrades. And so I think investors are going to be curious to see, what does the upgrade cycle look like for this particular device? And then really the bigger story is, can Apple create some innovations with AI that push the next upgrade cycle to be even more aggressive? We may not learn that tonight, but I think we'll get at least a sense for what can we expect from this cycle.
Doug, I feel like I've been hearing about the upgrade iPhone cycle since 2016, that I'm like waiting for that meaningful moment to happen. And at the end of the day, it's just straight up all about iPhone sales. Do you think that Apple has reset the bar low enough?
It has been a while since we've had a super cycle kind of upgrade theme. I think the bar is probably low enough. I mean, if you look at where investors were even prior to the Apple Intelligence announcement, it was kind of something like mid-single digits year-over-year growth. I think expectations are probably still in that window. But as we go into next year, 2026, I really think that is probably what will ultimately move the stock. Can we get the iPhone back to maybe low double-digit growth? We don't happen to own Apple in our AI-powered fund at Intelligent Alpha, so our AI models are not betting on that. But I think that is the fundamental question for investors who do own the stock.
No, fair enough. One of your top holdings, of course, is NVIDIA. NVIDIA having a real tough week, not only DeepSeek, but also pressure from the government on chip restrictions to China. What's the downside potential here for you on NVIDIA?
I think a lot of the big questions about what does DeepSeek ultimately mean, does it mean that companies can build these frontier AI models for cheaper, with cheaper hardware? I feel like we've had a full response from everybody from Meta to Microsoft last night. Dario Amodei from Anthropic, he came out and gave a very long analysis about how they are building their frontier models. And the universal response has been that infrastructure is still critical in terms of building these frontier models. We can question how DeepSeek did what they did, but I think the bottom line is this. You think about the next year or two of NVIDIA earnings, I think they're still very well intact. I don't think anything from DeepSeek will impact the amount that these companies will spend on NVIDIA chips for the next couple of years. You put that in perspective, you look at next year's earnings, NVIDIA trades now at like 21 and a half times next year's earnings. That starts to look a little bit more attractive than it did certainly a month ago.
And funny, as you say that, NVIDIA, which has spent a good portion of the day in the red, down as much as 4% on the day now, poking into the green, trying to recoup some of those losses from the earlier sell-off. And it raises a question, Doug, about, I guess, what valuation is and how you value something that still has not actually shown up on a lot of those balance sheets, on a lot of those income statements. I know there's a lot of promise for the AI spend, and I'm kind of looking beyond just NVIDIA. Give me a sense here. Do you sort of have to model that now, or can you sort of model it with kind of that big asterisk of, okay, something else to come?
I think you do have to put a bit of an asterisk on it, but it depends on the company, Romain. I mean, look at Meta. And they talked, I think, a lot about last night, this idea of them actually implementing what they're doing in AI to improve their product, to ultimately drive revenue, and then even expanding the concept to say, look, we're going to try to drive revenue with our innovations in AI, and then use that incremental revenue to fund continued investment in AI. So it's sometimes hard to put an exact number, right? For Meta, for example, 21% plus year-over-year growth in their ad business, which has been phenomenal. I'm not sure how you could parse out what part of that is coming from AI. Certainly part of it is coming from that. But as we look forward and we kind of get through some of this heavy investment period, I think you could see continued strong kind of double-digit growth from them and them maintaining these 60% margins. It makes for a great investment.
Doug, always great to talk to you. Doug Clinton, founder and CEO over at Intelligent Alpha. Conversation here about big tech, a mixed day for big tech here on this day. But of course, that could change once we get to 4 p.m. and we start to get those earnings out of Apple and Intel.
Yeah, and it also raises the question, like, how do you charge for these models, right? ServiceNow, for example, changing the way they're charging for AI. How do you manage that, right? Like, how do you price that as an investor when you don't know what that revenue stream is going to look like at the end of the day?
Yeah, and I was taking a look at this idea of kind of like, you know, are people really coming in and buying the dip off that? I mean, NVIDIA's really been struggling to sort of regain that traction. But a lot of the Mag 7 names, and when we talk about this idea of sort of whether they were so highly valued that it wasn't worth buying. And again, you look at what Microsoft said yesterday. Yeah, they got killed, but at the end of the day, the cash flow was still there.
Yeah.
The profitability was still there. I know there's a lot of concerns about spend, and of course, the pace of growth may be potentially slowing in Azure, but we're still talking about a company, at least on their main cloud business, growing 30%.
Also, in theory, if you wind up spending less, isn't that good eventually? Like, if this is the top year of $80 billion, if it spend less later, that's good, right?
You're not asking for logic in this market, are you?
Yeah, sometimes it's confusing.
All right.
Speaking of.
All right, we are moving closer to the closing bells. The S&P now getting a strong bid, up about 0.5% right now as we head towards the close. The Russell up about 1%, and right now looking at yields here, camped out, really going nowhere. Romain Bostic alongside Alex Steele. We bring Scarlett Fu into the conversation with those closing bells. Scarlett, now just about 1 minute away.
Yeah, you know, the market did take a little bit of a leg lower. We're still up on the day, but the S&P 500 paired its advance because 24 minutes before the market closed, you had Donald Trump saying he will impose 25% tariffs on Mexico and Canada by the February 1st. Both the peso and the loonie sank. They have come back a little bit here, but kind of surprising he started with these two countries, given that all the rhetoric on the campaign trail was about China.
I was also surprised just that markets move so quickly, because this is something that he has been saying on the campaign trail. He's also said this since he got elected, so it was a little confusing as to the initial market reaction that was so strong.
And just because a reminder here of just how much he can move markets. It doesn't really matter if what he says is true or whether it is going to have an impact. If he speaks and people fear it, then the markets will move. We should point out, though, that the reaction to those comments, most of those losses have been erased here. And now you're looking at green across the screen for most of the major indices here on this Thursday afternoon. The Dow up about 170 points or 0.4%. And S&P 500 up roughly 30 points or 0.5%. The NASDAQ composite is going to close higher by about 49 points or 0.2%. And the Russell 2000, look at that, Alex Steele. That is your outperformer, Scarlett, up 1% here on the day.
And you wonder how much of that is tied to evidence that the U.S. economy is doing just fine. I mean, the fourth quarter numbers came in a little bit lighter than anticipated, but still showing growth. And the earnings reports that we've gotten this earnings season so far, fairly solid, even if some of the outlooks haven't always lived up to expectations.
Yeah, let's check out the IMAP here. Just take a look at some of the sectors that did well and did not. It's a little bit of a mix here, right? You have utilities outperforming and real estate and healthcare. Questions like, is it defensive or is it still the energy power AI play?
Yeah, I mean, really when it comes down to it, tech is the biggest segment of the stock market, and that's down 0.5%. Everything else is in the green, but it's hard to say that it's an update overall when such a big part of the market is continuing to show some weakness following this week's revelation of DeepSeek and its successful AI model.
Earnings were a big part of the story today. They're going to be a big part of the story after the bell. Intel earnings crossing the wire right now. I'm going to start with the forecast. The company saying that for the first quarter, revenue will be $11.7 billion to $12.7 billion. billion. The high end of that range is below the average of street estimates, which was looking for 12.85. The company also saying the gross margin for the first quarter on an adjusted basis will also come in lower than estimates, 36%. The street was looking for 39. Here is your fourth quarter numbers. Revenue of $14.26 billion. That is a beat over street estimates. And the bottom line also a beat as well. The company, guys, no update right now on a search for a new CEO. The share is moving lower.
Yep, and taking a look at some of the segments here. So you're looking at data center and AI revenue coming in at $3.39 billion. That actually did beat estimates. Taking a look at the client computing revenue, for example, up a little bit over $8 billion. In looking at analyst notes, though, they're like, who cares? What about PC sales? We need a CEO, right? So sort of taking a lot of this in stride. The stock, though, down just a touch.
Yeah, but for what it's worth, the interim co-CEO, David Zinsner, did make some comments talking about this outlook that remain. You showed us missing analyst estimates reflects seasonal weakness magnified by macro uncertainties. And of course, we go back to the policy uncertainty under President Trump, further inventory digestion and competitive dynamics. And here's where the concern really lies, because when it comes to data centers, Intel is losing ground to AMD and to NVIDIA.
Well, yeah, and we talk about this idea of how do you turn around a company when you don't actually know who's going to be leading that company going into the future here. I just want to put a finer point on this, too. We talk about revenue in the most recent quarter, that fourth quarter. That was down 7%, if I just want to double check this. So 7% looking at the Bloomberg terminal here. 1, 2, 3. We're now talking about 3 straight quarters. And really, this goes much further back than that, because remember, guys, they had that sort of one outlier quarter in the Q1 where they did actually see revenue growth. But this is a company on a quarterly basis that has seen revenue slide now for years, and there is no analyst estimate out there right now, at least on a consensus basis, that sees that turning around anytime soon.
Nope, and they did have some color in terms of the different demand. They did say that some of that fourth quarter demand, though, even if it is slowing, was pulled in ahead of some tariffs, and they are being prudent when it comes to the forecast, but nonetheless. They also say that competitive data center chips are going to take a bit of time. I don't know how you quantify taking a bit of time, guys.
Well, this is what they're going to be pressed on, I'm sure, in the conference call when they do host that. That and, of course, the idea of what are you doing to find a permanent successor? These co-CEOs, that's fine, but we know that co-CEOs don't tend to be a long-term solution for a company, especially one that is in turnaround mode and needs to convince investors that it's figured out its path forward.
The company is talking about that 18A technology, saying that it is ready and saying that it is now proven technology here. And, of course, this could be a big part of the turnaround plan if they can get that advanced technology out the door. Not quite clear just from that one statement out of Intel whether they're there yet here. But again, the headlines now crossing saying that they are negotiating the right pricing for that 18A customers. But again, this is a company that has a long way to go to catch up with what's been going on in the zeitgeist.
I'm just looking through the fourth quarter numbers. And again, I know that the quarter ended matters less than with the outlook, but fourth quarter data center and AI revenue did come in slightly above expectations. $3.39 billion versus the analyst estimate of $3.37 billion. Client computing revenue also coming in a little bit higher, $8.02 billion versus $7.88 billion as predicted by analysts. So the fourth quarter numbers are decent. Operating margin on an adjusted basis, 9.6%. That is more than double the consensus estimate of 4.12%.
Yeah, and speaking of, adjusted gross margins for the quarter before were like 18%. It was a ginormous miss. So that clearly may be a bright spot. And I got to tell you, the stock is kind of jumping around all over the place. It was down at 1.3%, and now it's up by about 1.5% as we digest the profit and the current quarter sales falling short of those analyst estimates.
Yeah, I'm going to go to another tech earning that is just crossing the wire right now. That is Atlassian. Remember, there was a big focus on the software companies coming out of that somewhat disappointing report out of Microsoft yesterday. Atlassian, those shares up 12% in the after-hours trade. The company saying that its cloud subscription revenue in the most recent quarter, or this total subscription revenue of $1.21 billion, that is a beat. Cloud revenue stripped out $847 million. That's also a beat. Operating margin in the fiscal quarter, 26%. That's also a beat here. And your bottom line number, EPS on an adjusted basis, 96 cents a share. The street was looking for 75 cents a share. And here's your guidance real quickly, guys, going forward here. Revenue, $1.35 billion. The street street was looking for 1.32. The company also guiding higher on gross margin, operating margin as well. Those shares now up 24% in the after-hours trade.
All right, let's switch gears from tech for a second. Decker's also out. They're looking at revenue growth for this year. That guidance raised to approximately 15%, delivering pretty strong sales for the third quarter. Their net sales coming in at $1.83 billion. That definitely beat estimates, and earnings coming in at about $3 a share. Taking a look, though, at that stock, down by over 7%, with those net sales up by about 17% year on year in the third quarter.
All right, another tech name reporting, KLA Corp. Second quarter revenue, $3.08 billion, higher than what was anticipated, which was just under $3 billion. And for the second quarter, adjusted EPS of $8.20. That's well above the consensus estimate of $7.77. Not clear that we're comparing like with like here. Second quarter CapEx, $92.3 million. Analysts were only looking for spending of about $68.5 billion. In terms of the revenue for this quarter, the chip equipment maker says third quarter revenue will be $2.85 billion to $3.15 billion. The consensus estimate was for $2.89 billion. So the high end of that range, certainly well above the expectation that analysts have laid out there.
KLA right now, the second biggest gainer in the after-hours trade. Atlassian, the number one. Let's take a look here at Visa. The share is relatively unchanged here after the company's numbers pretty much coming in line with estimates in that first quarter, that fiscal first quarter. Adjusted EPS at $2.75. That's up from $2.41 over a year ago, and that's higher than the estimate of $2.66 that the street was looking for on an adjusted basis. Payments volume at constant currency up 9% in the quarter. The street was looking for a gain of just under 8%. So it looks like a beat for Visa there, a modest increase in the shares here as we keep an eye on all the and we keep an eye here on all of the after hours movers here. Visa getting a modest bid. Intel up about 2%. KLA, which Scarlett was just talking about, up about 5%. Atlassian right now up about 18%. The guys, of course, we are still waiting to hear from Apple. Stick with us. We're going to have more coming up right here on The Close.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Romaine Bostic. A bit of a sloppy day on Wall Street today, but the net effect of it was, well, for the major indices, a slight move higher. The S&P 500 closing out the day up about 0.5%. You saw similar moves on the NASDAQ as well as the Dow, though you did see some weakness in the cyclical space. We should point out, while a lot of the gains earlier in the day were being driven by earnings and some relatively positive economic data on the GDP front, as we got deeper into the afternoon, some commentary out of the White House, particularly when it comes to the potential for tariffs, new tariffs on Mexico and Canada, and an increase on tariffs in China. President Donald Trump now speaking about that in the Oval Office down in Washington. We saw that those comments affect some of the assets outside of equities that include the Mexican peso, which weakened by about 1% here on the day. Spot gold, which is already trading near a record high, continued to add to those gains. You also saw moves today in lumber, oil as well.
Yeah, record gold there for gold. And we'll continue to keep an eye on that. So let's stay with another gainer here. Las Vegas Sands closing up more than 11%. One of the big gainers in the S&P 500 after its fourth quarter revenue beat estimates, which is notable given that sentiment heading into the earnings report was fairly negative because of concerns around Macau. UPS falling by the most ever, down 14% on the day. Full year revenue trailing analyst estimates, and UPS, as the CEO Carol Tomé was telling us, is cutting its business with Amazon by half in order to reduce its reliance on low margin customers. And I included Hewlett-Packard Enterprise and Juniper Networks here, each down by about 2%, because the Department of Justice under President Trump is suing to block HPE's $14 billion acquisition of Juniper because the deal would consolidate the enterprise networking space to two players from three, which is notable given that for all the optimism that Donald Trump's administration will be, very light touch on M&A, very encouraging on deal making. This is a reminder that may not be the right assumption. Romaine?
All right, a lot happening here in the after-hours trade. We are still awaiting earnings out of Apple, but we already got earnings out of another important tech company, and that is Intel. The shares, which had initially dropped, now climbing slightly up about 1% here in the after-hours trade. The company missing, actually beating in the most recent quarter. Its guidance, though, definitely very conservative and missing some estimates, though some of that conservatism might be tied to the fact that they still have not sorted out what the CEO situation is going to be going forward. The company is saying that they have decided that they won't spend speculatively and that they will be conservative in that guidance. Matt Bryson, Managing Director, covering hardware, equity research at Wedbush. He joins us right now. Intel, were you actually disappointed, encouraged? Well, I mean, what was your kind of main feeling when you saw this report, Matt?
I think we got a lot of what they told us we were going to get. So numbers were a little bit different. Q4 was a little bit better. The guide was a bit worse. But they told us during the quarter that they were seeing PC customers pull in demand because they were worried about tariffs. That's got to come out of calendar Q1, and that's pretty much what we got.
What is the turnaround here, Matt? I mean, are we just kind of in a wait mode until the board finally figures out what they're going to do with leadership, or is there something that they can maybe potentially articulate on the conference call today that would actually, create a little bit more, I guess, of a bullish sentiment?
Yeah, I think it's two things. So I think from an execution standpoint, they need to prove that their fabs can work again. So the 18A process has to be a good process. The problem is they're talking about ramping that in 2025. They're talking about Panther Lake in second half of 25, which is all is as expected. But until we see those products, it's hard to tell. And then to your point, yeah, in terms of if you're going to really shift Intel, so who's the next CEO? What's the strategic plan? Is there a breakup? What are you going to sell Altera for? I mean, all those questions, I don't think they're going to get answered on this call.
So, Matt, Intel leaders saying that they're taking a prudent approach in forecasts. How much do you read into the forecast that they do provide at this point, given that they're purposely giving themselves room to beat a lowered bar?
I think that you should set a bar that you can beat, right? No one wants numbers to be disappointing. So I think there's a little bit of that in it, Scarlett. But I also think, again, when you look at the PC group, that's where the outperformance came in Q4. Certainly, you have companies like Dell that manufacture in Mexico that have to make product before potential tariffs, and so some of that is also coming out of Q1. I think it's a combination of manufacturing ahead of potential tariffs and a bit of conservatism.
Right. Okay. I know I don't want to keep banging on this drum, but the idea that they don't have a CEO right now and the fact that they have been in cost-cutting mode, reducing their staff, what does that mean about talent bleed? And do they have the number of people that they need to move forward on these initiatives at a time when a lot of the employees may want to go to other companies?
Yeah. So it's really hard to say in that when you think about the places they need to execute. So again, that 18A process for their fabs, that's something that's been in the works over the last 4 years. And so if it's going to work, it's really all of the work they've already put into it. I don't think it's so much a personnel thing right now, but having said that, uncertainty is always bad for companies, right? It's like uncertainty is bad for the market. You want to know where things are headed to be comfortable in the position you're in.
I am curious that when we kind of get to some of the other chip makers a little bit later, later I should say in February, Matt, what is kind of the overarching story going to be? Because we know kind of what's going on with Intel now is somewhat idiosyncratic. I know they're dealing with broader issues as well. But for those companies that aren't dealing with the issues that Intel is having right now, could we see a little bit more optimism when they report?
I think so, Romain. I think the question, though, is, so we've had this AI hardware trade going on for some time. Right now, you have a little bit of a dichotomy in that there's some concern around the short term. Is NVIDIA executing plan? And they pull a lot of the other chip makers' products with their results. And then you also have now this concern around DeepSeek. At the same time, you also have all this news around spending continuing to lift, right? We heard from Microsoft, we heard from Meta, we have more getting invested in OpenAI, which I think ends up being spent on capital. So, I think there's a little bit of uncertainty. At the same time, with all that CapEx being strong, I think everyone's going to have a relatively positive message like we got from Taiwan Semi earlier this month.
All right, Matt, really appreciate your joining us today. Matt Bryson is Managing Director covering hardware equity research at Wedbush Securities, giving us his instant analysis on Intel. We also have earnings coming out for U.S. Steel. The company reporting fourth quarter net sales, basically matching analyst estimates, $3.51 billion. Fourth quarter adjusted net loss was $28 million. Analysts were looking for a loss of $19.5 million. So this was a wider loss than anticipated. Adjusted EBITDA was higher by about $40 million, $190 million compared to the consensus estimate. And the outlook for this quarter is adjusted EBITDA of anywhere from $100 to $150 million, when in fact analysts were looking for just under $150 million. So certainly the low end of that range, well below the consensus estimate.
If you're looking for any commentary here about what's going on with Nippon Steel, we'll keep looking here. Other than the legalese at the bottom, no mention of it. I'm sure it will come up on the conference call.
Yeah. All right. We will continue to keep an eye on those developments. U.S. Steel rising about 2% in after-hours trade. Coming up, big tech is eating itself alive. That's what our next guest says. We'll be speaking with Mihir Desai. He is professor at Harvard Business School and Law School. Coming up next. This is The Close on Bloomberg.
Big tech is eating itself alive, so says our next guest, and Monday's correction shows markets, quote, maybe starting to reflect an understanding of this dynamic, or are they? Here to discuss that is the author of that piece. Mihir Desai is professor at the Harvard Business School as well as the Harvard Law School. And this was a fascinating column because it kind of comes right at a time where not only are these companies spending a lot of money, but investors seem to be shrugging it off. And I want to kind of go back to yesterday. Yeah. What we heard out of Meta, what we heard out of Microsoft is that spend is not going to stop. It's not. We are now on pace, at least if you believe their commitments, record levels of CapEx spends, and investors seem to, at least for now, be comfortable that's not going to affect credit quality, it's not going to affect their bottom line. Your column kind of makes this analogy that this could be kind of the snake eating its own tail, and we just haven't realized it yet.
Yeah, this image of the Ouroboros is kind of crazy. Yeah. And it's been around for millennia. But I think that's effectively what's happening. They're eating themselves. And what does that mean? They've become viewed as the safe asset in the world. So investors worldwide bless them with low expected returns because they're viewed as like fortress balance sheets, fantastic management teams, and they are. The problem is, of course, that low expected return is going to be resulting in them making investments that may have very low returns as well. Yeah. And I think that's in fact what's going on. And they're spending it on each other. So NVIDIA's customers are other big tech. They're buying back their shares hand over fist. They're doing CapEx with each other.
Well, that's what I'm curious about, too. And I'm a bit of a history nerd. So you also kind of referenced the railroad boom. And everyone knows that was kind of one of the first really big, at least in the modern era, financial bubbles that we had. And it was kind of similar. You had these companies that were making money hand over fist. They were legitimate businesses, but it became so incestuous and the spend just got so out of control. Eventually something broke. Now, obviously, the government kind of helped break it. But at the end of the day, it did break down. Is that a fair analogy to what's happening, though?
I think so, because I don't think the tech bubble of 2000 is the right analogy. Because those were not really big companies. Those were kind of somewhat fly-by-night operations that got bid up a lot. These are the world's best companies doing something at a scale we've never seen before. And I think the railroads are a good analogy. I think the Nifty 50 from the early 70s is a good analogy. And ultimately, I think we are all just levered to the Mag 7 in a way we don't understand. The markets are levered because it's a third of market capitalization, and now the economy is levered to the Mag 7. And now there's a huge set of capital allocation decisions they're making, literally hundreds of billions of dollars, and I don't know if the returns are there. And I think they're investing in part because they have to, or they feel compelled to, because they have so much cash and they have access to so much cash. That doesn't mean they're wise decisions. It just means that they're making them.
So they're basically doing it because of FOMO and because everyone else is doing it, and that's what's expected of them. I like what Romain said about how maybe the government kind of helped accelerate what we saw with the railroad companies and the monopolization of everything there. Is the government helping to do anything in this instance?
I don't think so. I mean, if anything, I thought the AI announcements by Trump were really interesting, where he brought Altman and Son on stage with Larry Ellison, and if anything, I think what the government is saying is if you don't plunk down $100 billion, you're not a serious player. And in a way, oddly enough, I think AI spend is going to become like a political litmus test of sorts. Like, are you with us or not? Because then the companies have to say, I'm good for $100 billion.
Right.
And so now, if anything, that's kind of amplifying this dynamic, which is we all have to spend hand over fist. in a way that we've never seen before, frankly.
Including companies that may not have the cash, if you believe what Elon Musk is saying about SoftBank, or in the case of Oracle, which is more of an old legacy tech company. Is that dangerous then, that old legacy tech companies are getting involved too and feel the pressure to have to spend similar amounts?
I think so. I mean, I think ultimately, what does DeepSeek teach us? One answer is, oh my God, it's so interesting. There's a China angle on it. I think the real lesson is the competitive mode in this market is not there. It's not really clear how you actually have a barrier to entry, right? And what is the difference between all these products, ultimately? ChatGPT, Llama, all these things. And so their evaluations is predicated on the idea that AI is going to be revolutionary, A, and B, they get to capture the rents. Both of those are, I think, questionable. The second one became questionable on Monday because DeepSeek, and the first one is questionable because I don't think we've seen the products and the use cases. And that's really what's driving things, I think.
But the mode aspect is fascinating to me, too. And I can't remember which CEO it was, but it was one of the Mag 7 CEOs who was asked this question a couple of months ago about this idea of what the moat. And he basically said our moat is, the hundreds of billions of dollars that we can draw upon to do this. And I understand the hubris, and I understand the sort of braggadocio of it all. But when has money in and of itself been a moat for corporations?
You're exactly right. So capital is not a moat. It's not. It's not a moat. But it's very confusing. And so the way the race is evolving is you have to spend fast and you have to spend a lot because that is who wins. It's a little bit of a land grab kind of a story, right? It's not clear this market has that dynamic. Sometimes you do have that dynamic. In cable, you have that dynamic when there's a real land grab. But this is not like that. And so I really think that's questionable.
Is that the lesson from DeepSeek? I mean, obviously, there's a lot we don't know about how they did it, but we know that they did something, and we know that they did it at a cost that was significantly less than the hundreds of billions of dollars that these other companies are spending.
And it's not just DeepSeek. Again, these products are somewhat undifferentiable. They're just like literally not differentiable. And so it's just not clear. So there's two, I think, questions that are unresolved. One is, does all of this pay off in some use case that we have yet to see? And how deep and profound is that? And second is, who captures the rents? And for the valuations to make sense and for us all to be levered to the Mag 7 in this way, both of those questions have got to be answered, in their favor. And it's not clear to me that that's going to happen.
Right, and it's just going in one direction with algorithmic trading and passive investing as well.
Yeah, and I tried to reference that. There's a dynamic now which is just reinforcing it.
Mihir Desai, really appreciate your joining us today. Professor at Harvard Business School and Law School, please come back.
Thanks so much.
We're just moments away from Apple earnings remain. 4:30 is when the numbers come out.
Yeah, I mean, and this is going to be a big one here. Obviously, there's a big focus here on the actual smartphone sales themselves, the unit sales, and there's always been the typical speculation going on with will they or won't they. But I don't know, I'm more interested really in kind of what they're going to talk about with regards to Apple Intelligence, what the longer-term game plan is, because there was a rollout of this. Now, if you own an iPhone, you probably didn't know there was a rollout of it because, I don't know, I mean, they said I could download it, I did, and I don't know.
I have an iPhone 16, and I haven't done anything with Apple Intelligence, and I don't know that anyone has bought an Apple iPhone 16 to get access to Apple Intelligence.
Yeah, absolutely. So let's bring in Caroline Hyde into the conversation, the co-host of Bloomberg Technology, as we await those earnings out of Apple. And look, and let's just put a fine point on this. This is still a juggernaut of a company. We're talking about a company that, based on expectations, is going to report $124 billion in revenue. The question, though, Caroline, is growth going forward.
Exactly, because 124 billion is a record, but it's only 3.8% increase in revenue when we got rather used to double-digit growth coming from Microsoft, coming from Meta. So ultimately, this is also about trying to show where regionally they're getting the uplift. China, we know, is a problem. Have they managed to increase average selling prices enough, basically send more of their high-end phones there to make up for the fact that on a unit basis, they're being outstripped by the Huawei's and the local competitors? But to your point, why are we not buying phones as quickly? Because they're all too powerful, they're too good already. If you went out and bought an iPhone 16, I have a feeling it was because the camera was rather good. Because you wanted to change in size.
Can I push back on that? Because you say they're more powerful. But isn't it also that they're not really coming out with anything that's more powerful?
They're not flip phones.
Yeah, I mean, it's not that the phones are bad, but before it was like the new phone would come out and it was completely different than the last phone.
And now it's like little iterations. A slightly better phone, a slightly better feel.
Incremental improvements. And honestly, the reason I got an iPhone 16 was because I got a good deal on it from T-Mobile. So the incentives pushed me to make an upgrade.
And T-Mobile CEO joined us yesterday and said, look, from their perspective, iPhones sold really rather well. But Samsung has managed to not only get the foldable phones, but they're also doing it with an integration with an Alphabet. Look, for me, I'm getting pushed the upside of Google trying to have its magic generative AI with all my emails rather than the Apple necessity right now. So you're not buying it on that reason and reason alone. You're just doing it because of its cyclical nature. Services, though, is the big winner.
It is a big winner here. I do have to ask you, though, is Apple a player in the AI space?
No. thus far, and they haven't. Maybe that's their saving grace. Look, they actually saw an uplift to their stock on the back of DeepSeek's news because they haven't plowed billions into the creation of their own large language models. Yes, we know that they've set aside certain amounts of R&D and focus on it, but they've been looking at OpenAI as a contributor.
We have Apple numbers coming out. First quarter revenue, $124.30 billion. Analysts were looking for $124.1 billion, so slightly higher than what was anticipated, meeting estimates for the largest part. First quarter EPS, $2.40, 5 cents better than what was anticipated. Service revenue, Caroline was just mentioning, this is the growth part, $26.34 billion. Analysts were looking for $26.1 billion. And the biggest part of its business, of course, is the iPhone, coming in lighter than anticipated, $69.14 billion, whereas analysts were looking for $71 billion. And greater China revenue, $18.5 billion. Analysts were looking for about $21.5 billion. Caroline,
that's a big miss on China.
That is a big miss, but that was folded in. People knew this, right? It's losing market share to Huawei and to Xiaomi. This was not a surprise.
This is not a surprise, but the cash cow that ultimately is the iPhone is probably the one that everyone's going to be continuing to be worrying about somewhat. And they're going to have to talk. Look, we always very important to talk about what happens on the call, and we will be hearing more detail coming from Tim Cook about his own anxiety. Remember, also Counterpoint Research pointed us toward an 18% reduction in sales in China. And so we already knew that there was going to be probably a pretty ugly set of numbers coming over there. Today, they're saying in the actual earnings statement that Apple is reporting our best quarter ever. They're still trying to pick up on the fact that they had 4 percentage point growth, $124 billion company, and they're thrilled to bring customers to the best ever lineup of products in the holiday season. They're trying to talk up their chip side. That's where their R&D has been spent. They talk about Apple Silicon, unlocking new possibilities with Apple Intelligence, but it's just come a little bit slowly. The CFO, of course, has been talking about record revenue and operating margins as well. But this isn't a growth stock anymore, ultimately.
And it doesn't need to be, does it? I mean, I know we want it to be, but at the same time, we're talking about a company that can generate a ton of cash, and that may not be as sexy as, coming out with a splashy new product and talking about lofty AI dreams. However, at some point, Caroline, don't they have to do that? Don't they need something other than just the iPhone? I know they tried to do it with the Vision Pro, and that kind of fizzled out. You have one of those, right?
We actually don't tell everyone, but we've got the Meta Quest. But their Apple Intelligence is ultimately an R&D spend that people are not seeing the reprisal from at the moment. And remember about the car situation? They spent years trying to make an Apple car. They plowed money into it and had to pivot entirely. This is a company where they need to show the power of a new kind of product, and it's not coming yet. 2026, and Mark Gurman has talked about the new home products that we're going to be getting, and that will be a real linchpin for them. Is how are they going to becoming seamlessly within our home environment? But we do need another killer product because, as we can see, the iPhone not living up to expectations.
Yeah, well, sometimes it feels like Apple's a one-trick pony when you get half of your revenue, more than half of your revenue from one product, and you rely on one region for about 15% of your revenue as well. Caroline Hyde, co-host of Bloomberg Technology, thank you for taking us through Apple's results. We want to get some outside analysis on the company as well and bring in Gil Luria. He is D.A. Davidson's head of technology research. Gil has a buy rating on shares of Apple with a price target of $260. Gil, it looks like the product revenue coming in lighter than anticipated, $97.96 billion. Analysts were looking for $98 billion. It's pretty much in line, but that means Apple is really resting on services to drive some of the growth here. And when it comes to services, is that what Apple Intelligence is going to be part of when it really starts to generate some numbers?
At some point, Apple Intelligence will drive services, but really what we still need to wait for is for Apple Intelligence to drive an iPhone upgrade cycle. And you just talked through the fact that you haven't seen anything in the phone yet that would compel you, even though some of the functionality is sneaking in. You're getting email summaries. You're getting more intelligent notifications. You can edit pictures. It's not telling you that it's Apple Intelligence, but these capabilities are sneaking in. They have to get to a point where you do notice, you think it's great, and you encourage other people to buy new iPhones. That's really the only way you drive sustainable growth for Apple. That will drive wearables growth, and eventually it'll drive services growth as well.
Okay, so it has to become kind of embedded in your life where you are starting to use it and you tell other people about it and there's word of mouth. So in that regard, it's not so terrible that Apple is kind of behind the curve when it comes to AI. At what point, though, do we see that happening? Is it going to be with this device, or do we need to wait for iPhone 17 before people really, that effort starts to gain traction with people?
It's going to happen gradually, but it is likely to happen in the next year or two. And in fact, the big development this week was good for Apple, not just because DeepSeek exposed everybody else's excessive capex compared to Apple's more conservative approach, but because DeepSeek got us a lot closer to models that are very powerful and very small. Small, powerful models fit on a phone. That's where all this is headed. We won't need those giant data centers for all the AI we're doing. We don't need a giant data center to summarize document and translate and pre-populate and create images. Those types of models will reside on the phone, and Apple is going to be the one delivering most AI to consumers within a year or two. So that is the time frame that this is going to happen. It's just happening slowly and gradually, notably slower than we thought back in June after Worldwide Developer Conference.
Is it going to be good, though, Gil? Because there's been a big criticism with regards to their AI development. The idea that something like Siri and some of the other sort of elements that already existed that were probably really just kind of some sort of softer form of AI, that could have been a golden opportunity for them to really capitalize on this whole AI hype. And I know that quite hasn't happened yet, or at least publicly we can't see that happening yet. But do you think they understand that they have things already sort of within their walled garden that they could draw upon if they put some effort into it?
Absolutely, they understand that. And again, that's their huge advantage, is they have our calendar, they have our contacts, they have our conversation history. That's what's going to drive the really great insights for us, when we will be able to ask them to summarize our conversations, to reply to messages. The photo editing is going to keep getting better. We wanted it to all happen all at once, but the technology just hasn't moved that fast. And they need to incorporate the technology into the experience. They don't want AI to be on the side like it is right now when we go to Perplexity or ChatGPT or DeepSeek. They want it to be incorporated into the product, and that evidently takes time, but they understand they have the big advantage because they have all our information, and that's what's going to really drive the agentic behavior, the assistant behavior that we're seeking.
Do you think they need a partner, meaning a big partner in the AI space, to do this?
I think everybody wants to partner with them, and that's already happening. They have Google as a partner. They have OpenAI as a partner. Because they own the consumer, everybody is going to want to partner with them, and they're going to be able to leverage those capabilities. And again, importantly, they'll be able to leverage whatever the best AI models are. They don't need to develop those internally. They can use whatever the state of the art is, and that's what their plan is right now, until the models get small enough and they can just incorporate them onto the handset.
Gil Luria, D.A. Davidson's head of technology research, a closer look at Apple as we await that conference call here. A record quarter for Apple indeed, but some concerns here about where the growth is going to come from. When we look at their main product, the iPhone, $69 billion in revenue in the most recent quarter. That's missing street estimates of about $71 billion. Nabila Popal joins us right now to take a closer look at Apple and the smartphone market. She's Senior Director of Data and Analytics at International Data Corp. All right, so we kind of knew coming into this quarter that they weren't going to be moving a ton more units than what people expected. They still moved a lot of units, Nabila. Is there a sense here that this, I guess we call it a slowdown, if we will, right now? Is that temporary, or is this more of a structural shift in how we're buying phones overall?
Thank you. Thanks for having me. So absolutely, and I think I was hearing your conversations earlier. There's definitely, Apple came a long way, right? They had a very strong record-breaking year in 23. So certainly this year, there's been some challenges. We talked about China. We've talked about it many times. But also this year, right, there's been multiple things happening. The growth, the refresh cycles continue to grow. And so growth has been pretty flat in the developed markets, which are still, the macro challenges still remain. But the bigger, reason for the dent has really been the increased competition that Apple saw in China. So it was still number one in Q4, but it did see, a drop about 5% or 4% globally and about 10% in China. So that all amounted to a pretty flat, like we're showing about a roughly 1% decline for Apple in 2024, but it still, made it to the top.
Well, that raises the question, too, as to whether Apple has lost some of the pricing power, because that was always kind of the ace that it had up its sleeve, that it could pretty much put any price tag on these iPhones and people would pay them. We saw that with the release of the 16 and even to the 15, where those price increases were not quite as dramatic as what we saw in the past.
Sure, yeah, absolutely. Apple's selling price has increased. It was like in the mid 800s about five years ago in 2019, and now it's well above $1,000. And year over year, we kept seeing, ASPs grow, and still consumers were buying it, kind of riding that premiumization trend, right? But this year, of course, there's a big release with the iPhone 16, a lot of excitement around Apple Intelligence, but there's been mixed reviews, right? Like you said in the segment earlier, there hasn't still that groundbreaking, like actual assistant that could we could just talk to do multiple tasks for us. So imagine you're driving and you're able to say, hey, find the next concert of so-and-so for me and buy the tickets and put it on my calendar and send an invite. That's not happening yet. So that's really, remains to be seen. And that's when we think things will pick up once that grows.
Let's just focus on China for a moment here, because Mark Gurman, who's our Apple reporter here at Bloomberg, notes that Apple grew in every region outside of China. So every single market, Apple saw growth except for China. And this is even after analysts have noted some incremental discounting for iPhone 16s in that country. Greater China revenue for Apple in the first quarter was $18.5 billion when analysts were looking for $21.5 billion at least. So, Nabila, my question to you is, when you look at the offerings from a Huawei or a Xiaomi, does Apple just need a different strategy for China, a different approach to this market than what it's doing for the rest of the world?
So, you already see them changing their approach. And traditionally, Apple would never really play into the hands of like large discounts or big promotions, but they are changing. They're realizing that in order to compete in a market like China, they really have to, change their approach. So they're giving big promotions, discounts, but also it's a bigger issue than that, right? Yes, competition is increasing, but also consumer psyche and mindset is changing, where they're looking for more deals, more value driven. They're not lining up outside the store, whichever launch it may be, to buy the new device because of these incremental changes that we're seeing. But we're hoping that, next year or hopefully this year, as Apple solidifies a partnership with the AI models, local AI models in China, that we might be able to see some better growth this year.
Is the lack of Apple Intelligence and AI offerings the reason why Apple may not be able to gain traction in China? I mean, I hear about reports where Chinese consumers are looking to homegrown brands because of nationalism, because of those reasons, as opposed to wanting to buy another U.S. product. And then you also have, of course, Chinese government offices ensuring that people who work there use a Chinese phone as opposed to an Apple phone.
So the government issue has not really dented because the proportion of iPhone sales in China there's not a large proportion that leads to those government sales, but it's really the consumer sales that are driving. And yes, increased competition from Huawei, as well as a lot of the other brands, because if you look at the China data, you'll see that pretty much, Huawei, Xiaomi, Vivo all grew by strong double digits, but Apple, had a decline. So consumers are looking for, those brands are really targeting multiple, much lower price segments. Also, with the exception of Huawei, they're having multiple launches, many different products, a lot of deals. And so Apple is trying to, compete by offering the kind of promotions that it has. I think the most recent one was the highest ever that it has done. It was about a $500 discount, right, for the latest lineup.
There's been a lot of talk, Nabila, about this idea, sort of longer term, that the traditional phone, traditional modern phone, I should say, that we use, that could be a thing of the past. I mean, obviously, there's been a lot of talk about whether it's glasses or watches or other types of wearables, but the idea of just having that computer in our hand the way we do now could change. And I do wonder that when we get to that inflection point, are there companies out there that you've been tracking that maybe have an advantage in moving to that space and away from the traditional handset?
I think all of the smartphone makers are now looking where, what different form factor they can expand to or, change. We saw obviously a little bit of a change with the foldables, but really that's not what we're talking about. We're talking about a completely different device, right? Be it something that you wear, the glasses, or another kind of wearable. But Honestly, at this point, for the near long term, I don't see the primary form factor changing. But I think all the smartphone makers are investing in these different devices. I think we saw some teasers from a couple of the brands as well in the last weeks. And so, I think they're all just waiting. But as of now, the smartphone does remain the primary computing device for most consumers.
All right, Nabila Popal is Senior Director over at IDC, focusing on iPhone unit sales and, of course, the movement of those products in particular. iPhone revenue over at Apple coming in lighter than expected, $69.14 billion. Analysts were looking for more than $71 billion. So shares of Apple kind of bouncing around right now, little change at the moment. And, of course, the backstory here is that investors are hoping that DeepSeek's emergence will be a positive for Apple because cheaper AI models could contribute to an iPhone upgrade and a reacceleration in growth in the future. Joining us now to discuss and give us her take is Jana Eggers. Jana is CEO of Nara Logics. And Jana, that idea that cheaper, more efficient AI models means the AI tech can be accessed more directly from a device like an Apple iPhone or an Apple iPad rather than connecting to a server is good news for Apple and actually makes it okay that Apple has been kind of a laggard in investing in AI. Do you buy that argument?
I absolutely about getting further out to the edge. I think that's fundamentally true. I think the laggard part, I'm not so sure because so much of this, and we're hearing it with the examples of, what's going to drive an upgrade is incorporated AI. Well, incorporated AI is just such a big word. And what do people really want? So being that laggard has made them miss learning opportunities, right? So you get that even if it's a 0.1 out there, it means a lot. And so that kind of testing and iteration is really what makes spectacular products. And I think that's where the laggardness has hurt them.
Oh, interesting. Missing out on learning opportunities. Is that part of Apple's DNA, though? Apple likes to perfect everything and have it look beautiful before they roll it out.
Yeah, but they've rolled out. I mean, when the iPhone came out at first, think of the battery life, right? It was very bad. And so they've definitely had some things that looked beautiful, but maybe didn't have that back end. And I think that's the challenge with AI that's a bit different from their normal DNA is that AI is very much a back end type thing. And that's a little bit different from kind of the style that they've had in the past. And I'm not saying that they can't do it because I believe that Apple is this amazing company that can do a lot of things. I'm just more thinking of the consumer really knowledge of and understanding of how they would interact with this AI.
Well, and that's a good point. And I mean, with all the hype over DeepSeek, there were some questions raised, Jana, about the idea of just how good it is, or maybe not quite that good. I mean, there are basic functions that if you play around with it, clearly it can do. But when we talk about advancement and the idea of it being reliable enough to tell me, read my calendar and tell me what I need to do, or read me the news. We know Apple experimented with this, and we saw some of those news headlines, and they were not just wrong, but offensive. So I do wonder if taking a slower strategy rather than this, let's rush through the door with hundreds of billions of dollars in CapEx, that maybe that slow strategy could be more beneficial, not just for Apple, but really for any company in this space.
Yeah, I think this slower, what I would say is not necessarily slower, but more iterative. And that's where, I do think one of the advantages and something that's not quite as well known about the DeepSeek strategy is they're actually using what we call ensemble methods, meaning they look at different things in different ways. And you can kind of see this when you ask it a question, it starts breaking down the questions. And that's really more likely to be going to different models. And that type of ensemble method is probably something that Apple could be doing in terms of picking different types of AI, because it's not likely to be an LLM that's going to optimize your calendar, for example. An LLM is going to be a component, but that's not going to be the driving model.
Well, I mean, the good thing about this, and I am curious how much you've looked into this. I mean, a lot of people have talked about the fact that since it's open source, obviously you can kind of, create your own fork off of it and figure out what you want to do with it. Who knows if Apple is going to do that? I'm curious if you've done that, but more importantly, if a company does do that, do you think it could be a viable alternative to, I guess, what right now is the number one alternative, which is just going through OpenAI or Anthropic?
We've looked at it. We've brought it in. We're curious about it. I just had some meetings yesterday on it and what it means. I think, you really have to understand, we don't do, honestly, a lot of LLM work. LLM's kind of like a complement to things that we do, but our core isn't LLM work. It's not that language based. It's just like our brains, because we focus on decision AI, our brains actually don't make decisions language based. Language is an input vector and an output vector, but actually the decisions are translated into something else. And so think of it a little bit more that way and how we use it. And so I think that it could give some people advantages that it is open source, and they can see what's happening there, which I think is great. I think it will teach some of the U.S. technology companies about that kind of approach, and they'll learn more. But, DeepSeek did use, some of what was done with the now more traditional LLMs. And so while it's a smaller model, it was also built using information from those bigger models. And that's kind of a question because it doesn't. Yeah.
Jana, just real quickly, were you, when did you become aware of DeepSeek? Because for folks like us who don't follow this is relatively new to us. This came to my attention January 9th. Some people kind of learned about it in late December. But this is a company that, at least in its formal status, has been around for at least a year. When did you become aware of it?
Yeah, it was more when they released a paper, which I think was a month or a couple months ago. Yeah, I can't remember when the paper came out first. And it wasn't until the consumer product came out that it really, people started noticing it and playing with it and saying, hey, this is pretty good. But the paper actually did detail, the decreased compute power that they needed.
All right, Jana, I really appreciate you taking time for us. We have to leave it there. Jana Egger, CEO over at Nara, as we continue our coverage of Apple's earnings here, and a lot of details to sift through this afternoon, including, what the product strategy is going to be going forward. Mark Gurman knows that better than anyone else. He's our chief technology correspondent here at Bloomberg. And Mark, I want to start off first with the column that you wrote, I think, at the end of last week, that you really can't count Apple out yet in this world of artificial intelligence and augmented reality. I know the Vision Pro wasn't necessarily the big hit that they thought it would be, but what about the underlying technology? How much usefulness is there left in that?
In my view, Apple has all of the pieces to be successful in artificial intelligence, in augmented reality, in mixed reality, all of these emerging technologies. The problem is they have been very much unable to put the pieces together and execute in the fashion they used to be able to execute in, right? You've seen this with Apple Intelligence, their AI platform. At a high level, this privacy-centric approach, this on-device large language model approach, similar to what we've been seeing from DeepSeek, it makes a lot of sense, right? But they don't have the right algorithms, they don't have the right technologies to be able to push this into a place that will make it mainstream and as capable as what we're seeing from the competition. Now, in my column last week, I outlined that Google with Samsung, you're seeing other companies, Meta, of course, at the top of this list, coming out with these augmented reality glasses in a few years. Apple's a looming threat because of their advantages in integrated software and hardware. They're able to create the hardware stack and the software stack in addition to the services simultaneously, which allows them to be more efficient and link those different properties together more closely, which often creates a better user experience. The other thing is Apple has a massive advantage in manufacturing scale, manufacturing partnerships, the ability to get the margins it wants, but also in very low power silicon. And combined with AI, there are some very compelling products that they can release down the road. The question is, how long is it going to take to release those products, and are they able to bring everything together in a compelling fashion?
Well, let me just take that question and throw it back in your face, Mark. I mean, have you gotten any word here on maybe what we could potentially see from them? And I'm talking about in the short term. I mean, are they just going to walk across the stage at their next product announcement and just announce a new iteration of the iPhone, or an extra, a few, memories in their Mac computers? Or are we going to see something really new and special?
Well, in terms of the short term, and for Apple, I look at the short term as over the next 12 months. So we're still the end of January here. So for calendar year 2025, you're going to see a new MacBook Air in short order here. This is going to have a new M4 processor that they've brought to some of their other Macs in recent months. Part of the reason why you saw the Mac become a $9 billion business in this prior quarter was because of that M4 chip in these new Macs. So that's now going to expand to the Air, though the design is going to be the same. You're going to see a new iPhone SE that's going to be the first low-end iPhone with AI capabilities. It's going to come at a little higher price point, but it's going to have a more modern design. I think this is going to do pretty well in China and other emerging markets, and is going to steal some people away from Android.
Right.
Later in the year, you're going to see a new smart home hub, so Apple's entry into the smart home. That's going to be compelling, but I don't think that's going to be a major revenue driver. And then later in the year, you're going to see what I'm calling the iPhone Air, which is a mid-tier, thinner iPhone, which I think is going to be quite compelling. But because the new features and design are coming to that mid-tier phone, you have the potential there for ASPs either not to grow or come down a little bit in the fourth quarter.
Okay, so these are still tweaks on the existing iPhone itself. In the spring, I believe there's going to be an Apple Intelligence software update, 18.4, which includes a Siri update. Is that going to be enough to compel people to want to go out and upgrade to the new iPhone so they get access to Apple Intelligence? Because right now it's kind of a nebulous idea that's out there, and if you happen to have the iPhone 16, yeah, maybe you might check it out, but otherwise it doesn't really it's not something that people are really interacting with on a at scale at the moment.
As we sit here today, Apple Intelligence is very much a marketing gimmick. They changed the user interface a little bit, but they really didn't go under the hood and change much. That changes in 18.4, which is supposed to come out in April. We're talking about Siri changes, the ability to tap into what's on your display, to tap into your personal data, to tap into your apps at a much deeper level in order to really allow you to manipulate the operating system using AI. But it's going to take some time for third-party app developers to adopt these technologies. So far, we have not seen a smooth rollout from Apple Intelligence, so I think the story is yet to be told on how Apple Intelligence is really going to develop this year. In my view, and in the view of many others, Apple needs a leadership change for its artificial intelligence efforts. There is a reason that they have been behind over the last several years. They brought in John Giannandrea from Google, who was the hottest hire that Apple has done at the executive level in decades, and that needle has not really moved much. And Apple should, with its core technologies and its ethos, and of course its unlimited resources, be doing a lot more in the space.
Mark Gurman, our chief technology correspondent, a closer look at Apple. The share is moving lower here in the after-hours trade, but only by about 1%. We should point out Walgreens Boots Alliance also taking a big drop in the after-hours trade, down 8% on the suspension of its quarterly cash dividend. A lot of earnings coming up tomorrow in the morning, including out of Chevron, Exxon, and Phillips 66. We'll be back tomorrow in the afternoon right here on The Close.